right, welcome to Life Agent School Training Hub. We are a resource for life insurance agents across all different platforms, regardless of company, IMO, FMO, independent, doesn't matter. We're here to add value to you on a weekly or bi-weekly basis. So today's training is product training specific, and today we're going to be going over common riders for life insurance policies explained. All right, so common riders explained. The very first one that you're typically going to come across as an opportunity to add for a client is the child term rider. It is a rider that's added to the life insurance policy of a parent, grandparent, or legal guardian, and this is carrier specific. Some carriers will allow a grandparent to add a child as a rider, and others will not. So you have to make sure you know your carriers and what their specific guidelines are. With some carriers, you can insure up to 11 children. Let me tell you what a blessing that is to be able to provide a parent who's looking for coverage for themselves and their children, and they are on a significantly limited budget. This is a great opportunity to be able to insure an entire family up to 11 children, again, carrier specific. Some carriers will insure up to 6, some to 8, others up to 11, and some maybe even more. The issue ages, also carrier specific, are from 0 to 18 years of age. It's traditionally going to be based on their current age, not necessarily their attained age. Again, carrier specific. So you want to make sure you know what the guidelines are for the child term rider with the particular carriers that you represent. Okay. There are some carriers that will only allow a child to be insured up to the age of 16. When they're 16 years of age, they're now considered able to get their own coverage. And so again, it'll be carrier specific. Now don't mistake don't confuse the issue age for the insured age, meaning that a child can be insured up to the age of 25 on a rider, which means, let's say that you have a client who has a 17-year-old child, or let's say in this case, an 18-year-old child that they wish to insure. That child will be insured from the age of 18 up to the age of 25 or until the child gets married. So it's different from the issue age. Issue age and up to when the child is insured, two separate instances, two separate scenarios. With the child term rider, it is considered simplified underwriting, which means that the child will not have to undergo any labs or medical exams. However, there are still going to be, in most cases, a couple of medical questions asked within that child rider section of the life insurance application. So let's not assume that because they're a child, you're completely healthy and they're going to get approved. It will still undergo medical and prescription history check. Okay. There is limited coverage. You're typically going to see coverage anywhere from 1,000 to upwards of 25,000. Some carriers call them units. So 1 unit up to 25 units. Each unit is valued at $1,000 of coverage. These child term riders are convertible to permanent life insurance policies, in some cases, even a term policy, without the child having to prove insurability. So it's a great way for a client to start their child off with a life insurance plan without having to pay extra for them to have their own life insurance policy, although that is also always preferred. Reason being is because let's say that the parent has a term policy and they have a term policy for, say, 10 years. If their child is only 4 years old upon attaining that coverage, then the child is only going to be insured up to when that term expires. Or if the parent passes away within those 10 years, then the child will only have up to a certain point, which is usually going to be 30 days from time of passing of the owner, for them to convert that policy. If no one knows about this policy outside of the parent who obtained the coverage for both of them, then their coverage will cease. Unfortunately, it'll terminate. So this is why sometimes it is better for the child to have their own policy. But when there are budget constraints, obviously, child term rider is going to be the way to go to be able to get that child some form of coverage immediately. Spousal rider. Similar to that of a child rider, the spousal rider is added to a spouse's life insurance policy. It could be a term policy or it can be a permanent policy. They must still be insurable. So unlike that of a child term rider, where it just asks a couple of, questions and they don't need to do labs or anything like that, the spousal rider is vastly different. So they do have to still apply for coverage with it, still within the same application, but the spouse still needs to qualify. So if labs and medical exams are needed, then that's the only way they can get that coverage. The spouse is under the rider, has no control over the policy whatsoever. They're not an owner. They're simply just an insured on the policy. So if changes need to be made, guess what? The spouse can't make any of those changes at all. If the policy is a term, the spouse is covered under the rider, or the spouse covered under the rider is at the mercy of that term period. So just like that child term rider, if the primary insured or the owner on the policy dies, the rider terminates. And there's also limited coverage for the spouse as well. So in most cases, the spouse can have a fraction of what the main primary insured has in coverage. Waiver of premium rider. This waiver of premium rider waives the premium of the primary insured if they become totally disabled. Coverage is going to remain active under this rider. They do not have to repay the premiums of any premiums that were waived prior to them becoming, active again. The waiting period is typically 6 months from total disability diagnosis, and they must show proof of disability from their attending physician in order to qualify for the waiver of premium rider. The cost, just like everything else with insurance, is based on age, health, any extracurricular activity. So do they skydive, bungee jump, anything like that could potentially disqualify them or rate them and make their premium higher for that rider will be considered. And then of course, occupation. So where you have maybe a clerical client or client who does clerical work compared to that of a firefighter or a police officer or someone with or construction, for example, that has the more dangerous occupation, the chances, the premium will be higher for the latter compared to someone who does clerical work. So with the waiver of premium rider, the waiting period is typically going to be 6 months. So meaning that the client, the insured, must be considered totally disabled for a period of 6 months before that waiver of premium rider kicks in. So they still have to pay their premiums during that waiting period. Now, with that said, let's say that they don't have a date in which they're going to return back to work and be able to make their premium payments. Well, that waiver premium rider is in effect, meaning they can continue to benefit from this waiver of premium rider and not pay any premiums while keeping their policy active for an indefinite period of time. So it's typically going to be carrier specific, but it will drop off after a certain age. It's usually going to be the age of 65 with most of the carriers. Accelerated benefit rider. So with some carriers, they call it the long-term care rider. Others call it accelerated benefit rider. It's synonymous. So it covers critical, chronic, and or terminal illness, meaning that you have some carriers who offer accelerated benefit rider, but it's only for terminal illness or it's only for chronic and terminal, not critical. So you do have to know the benefits and the riders and what is included within that accelerated benefit rider. Some carriers only offer terminal illness, while others offer all three benefits under the rider. Excess percentage of the death benefit. What does this mean? If, let's say, you have $1 million, your client has $1 million in life insurance coverage, they can access a percentage of that death benefit to utilize for long-term care needs. Now, there are specific medical conditions that are acceptable that can be used on this rider. So you do have to read up on those guidelines on what exactly is covered under the critical, chronic, and terminal illness rider, because they are specific to that carrier. It does reduce the death benefit to the minimum allowed. Some carriers have a minimum death benefit of $25,000. Others have it at $15,000. Some have it at $10,000. So If your client is using, say, a portion of their critical illness rider and they have $1 million in coverage, the minimum that they have to keep in the policy to maintain active, so something pays out in the event of death in the future, the carrier will specify that in their guidelines. Accidental death and dismemberment rider. This is not always common. Sometimes you'll just have the accidental death rider and not the dismemberment with that. Other carriers do have them both within the same rider. So it pays an additional benefit if the insured passes away as a result of an accident, not due to cardiac arrest 2 weeks after having an accident or due to an infection while at the hospital recovering from an accident. It needs to be specific to the accident itself. There are typically, and I'll throw this in there for your little freebie, there are typically going to be time limitations as to when that benefit will pay out to the beneficiary, meaning 90 days. So if the client or the insured doesn't pass away within 90 days, it can no longer be considered a result of an accident. And so this particular rider will not pay out to the beneficiary. Also, it pays a benefit to the insured if they lose a limb. That's where the dismemberment part comes in on this rider. So if they lose a limb or their sight as a result of an accident. As with the waiver of premium rider, qualification and cost is associated with this rider, and it is based on age, health, extracurricular activities, as well as occupation. So in some particular cases, a client may have too dangerous of a job, or they, go skydiving, bungee jumping, scuba diving far too frequently, where the insurance carrier will decide not to allow them or not to offer this rider to them. Payout for accidental death has restrictions. As I mentioned before, insured must pass away only due to an accident and nothing else. The date of passing must be within a specified period of time, usually 90 days, as I mentioned. And the payout for dismemberment is subject to the extent of an injury, and usually pays out a percentage of the total benefit, compared to accidental death, where it pays out the full benefit if the insured passes away due to an accident. Return of premium rider. So the return of premium rider reimburses all premiums paid if the insured outlives their term policy. This is not a very common rider, but it is one that we're going to start seeing more frequently. It is one that is still somewhat new to the industry. So carriers are now starting to introduce it. So just be prepared for that return of premium rider to be available to most of many more carriers in the near future. What it is it provides a guaranteed payout. So you may have some clients who have mortgages, perhaps they are paying child support, perhaps, perhaps they just like the idea of, hey, I like the idea of paying into something and getting my money back, like a money back guarantee if I don't pass away, which is pretty cool. So it does provide a guaranteed payout. Typically, you do have to have your policy for a period of time. It's usually going to be 20 to 30 years. And some carriers will pay out retroactively. So let's say if you decide, or the client decides to render their policy, say in year 15 of their 20 or 30 year return of premium term rider or policy, then they'll get a percentage. So it'll be retroactive, and they'll get a percentage of whatever premiums were paid into the policy. It could be 50%, 75%, whatever the carrier has in their guidelines. The monthly premium will typically be anywhere from 4 to 6 times more than traditional term. So this is where you kind of have to work with the client and determine what's the client's goals, what do they want, and determine if the return of premium rider is something that they really do need to add. So I'll give you an example. 35-year-old male needs $500,000 of coverage, and they need it for, let's say 15 years or 20, let's do 20 years, because that's the typical return of premium, right? They need it for 20 years. Let's say it's going to cost them $30 a month for that policy. Well, with a return of premium term rider added to the policy, that policy can jump anywhere from 120 to 180 maybe even a little bit more per month. So you see the difference. The difference is it's a significant amount. So sometimes it may even make more sense for them to get a permanent policy, like a cheaper, a more affordable life insurance policy, permanent life, like a GUL or something like that. If they're looking for, if it's something that the return of premium really isn't a necessity, but they like the idea of it. You see what I mean? So it's not always going to be, it's not going to always make financial sense for the client, if that makes sense. So, but return of premium rider is very enticing for the average person. Who's like, hey, I like the idea of getting back, let's say the client's putting in $100 a month into return of premium term policy, and at the end of 30 years they get back 36,000. That's a decent amount. It's not going to grow any interest, but they can count on that money coming back to them in 30 years, right? So it's pretty cool. And then guaranteed insurability rider. This one is very common, especially with children, but also with young adults. So 20s, 30s, perhaps. Maybe they have not yet started like their marital life. Maybe they don't have any children. This is a great option for them. And I'll tell you why. Because it allows the insured to purchase more insurance without the need to prove insurability. That's amazing. Anything can happen. We know we're all one intersection, one doctor's visit away from a life-changing event. And so having the ability to purchase more insurance through a rider is definitely going to benefit them potentially in the future, right? So there are going to be issue age limitations. So someone who's 45, 50 years old may not be able to add this rider because of their age. Specific option date. So some carriers have it where you can request more coverage through the rider during their policy anniversary date. And let's say maybe it's between certain ages, and it's say every 3 years or every 5 years. Again, it's all carrier specific. Most times I see it within like 3 years. So let's say the client is 25 years old and they purchase the guaranteed insurability rider. The next time they can increase their coverage is 3 years later. So when they're 28 years old, and they'll get a notification from the carrier that they have the option to exercise this rider that particular year, or wait until 3 years later to be able to exercise that option. Or during life events. So it could be when they get married, when they have children, when they have an increase in income. So again, all this can be carrier specific. It is really going to be less expensive than attaining a whole new policy later on in life. And so this is definitely something that they should consider getting sooner than later. It is an option. Typically that most of these riders are options only when you are applying for coverage. So I'll give you an example. With the exception, most of these, if not all, with the exception of the child term rider and the spousal rider, most of these others are going to only be available to add to a policy upon applying for coverage. So once you've applied for coverage, you get approved, premium has been paid. Typically, if it's past 120 days, you can no longer make changes to the policy. Otherwise, you have to resubmit for a whole new policy. There's another rider that is incredibly beneficial when you're structuring max funded policy. So whether it's done through a whole life or it's done like through an IUL or in an IUL, the term rider. So in most cases, and you'll learn this when we do our IUL training in the next month or so. But when you're structuring an IUL and even a whole life policy, you want to minimize the death benefit as much as possible so that more of the client's contributions go towards building up the cash value and not towards paying the monthly expense charges and cost of insurance that are that come with paying for a death benefit, because it is still a life insurance policy, right? So what a term rider allows is for you to minimize that permanent coverage that you get obviously with whole life or with an IUL, and then add additional term so that one, it prevents MEC, And number two, it addresses a little bit more of their insurable need as well. So just a quick little tip that sometimes a term rider does come in handy. And the more and more we see individuals looking to life insurance as a supplement to saving long term, term riders are going to be your friend. So that's a quick little tidbit of information I'm going to give you on term riders. But it's certainly going to come up quite a bit during our IUL training that we're going to be doing the next month or so. So hopefully this added some value to you all. For those of you who are registered and enrolled in Life Agent School with the Blueprint course, you will have access to this recording for future reference. And you'll also obtain a copy of this Common Writers Explained document that I have here that I shared with you all today.